Imagine a world before the Oracle. Before the billions, before the Berkshire Hathaway shareholder meetings that fill stadiums, before the name Buffett became synonymous with wealth itself. Go back further. To a time before the legend, when there was only the man. A young man in his mid-20s, standing in a living room in Omaha, Nebraska, in 1956. He has gathered the 7 most important people in his life: his sister, his aunt, his father-in-law, his college roommate, his lawyer, and their spouses. They are not titans of industry. They are family and friends. And they have entrusted him with their savings, a total of $105,000, a fortune at the time. This isn't a casual get-together, it's a constitutional convention for a financial empire that doesn't yet exist. And this young man, Warren Buffett, isn't asking for their money with a smile and a shoeshine. He is laying down the law. He hands them a short single-page document. He calls it the ground rules. It is not a suggestion. It is not a proposal. It is a declaration of principles, a non-negotiable treaty between his mind and their money. These rules were the first bricks laid in the foundation of the greatest wealth-building machine in human history. They were a masterclass in managing expectations, a psychological fortress against the madness of crowds, and a blueprint for aligning the interests of a general partner with his investors. Most people, when they look at Buffett's success, they look at the what. What did he buy? Coca-Cola, American Express, See's Candies. They miss the how. And the how, the entire operating system, the very DNA of his success, was encoded in these original ground rules. This is the story of those rules. More than that, it is the story of how you can forge your own set of ground rules, a personal investment constitution that will protect you from the single greatest threat to your financial future, yourself. We are going to deconstruct this foundational document not as a history lesson, but as an actionable guide to building a framework for lasting financial discipline and true, sustainable wealth building. We begin with the most audacious, the most absolute, and the most important rule of all. The first pillar of Buffett's nascent empire was the pillar of absolute authority. This was not a democracy, it was a benevolent dictatorship of intellect. The first and perhaps most jarring of his ground rules made this explicitly clear. He, Warren Buffett, would have the final and absolute say on all investment decisions. He would not tell the partners what he was buying or selling. He would not take suggestions. He would not call them for their opinion if the market crashed. Their job was to provide the capital. His job was to manage it. The communication would be a one-way street, an annual letter explaining the results, not the reasoning in real time. This wasn't arrogance. It was the ultimate act of intellectual integrity and a profound understanding of human nature. It was the establishment of a clear, unshakable command structure, the very first step in professionalizing the act of portfolio management, even on a small personal scale. To truly grasp the gravity of this, we must transport ourselves back to that Omaha living room in 1956. The anecdote isn't just a quaint story. It's the crucible where his investment philosophy was first tested against human relationships. Imagine being his sister, Doris Buffett. You love your brother, you believe in him, but he's 26 years old. He's asking you to hand over a significant portion of your net worth, money that represents your security, your future. And his primary condition is that you are to have zero say in what he does with it. You won't get quarterly updates. You won't get phone calls explaining why he just bought a stake in a small, obscure windmill manufacturer. You will give him the money, and you will wait. He told them point blank, "I will not be talking to you about the portfolio." Think of the trust required. His father-in-law, Dr. Thompson, a respected professional, a man from an older generation, was being told that his younger, less experienced son-in-law would be the sole commander of his capital. The social dynamics at play were immense. This wasn't a faceless transaction with a brokerage firm. It was deeply personal. The risk wasn't just financial, it was familial. A failure would not just lose money, it would rupture relationships. Buffett knew this. He wasn't naive. But he also knew a greater truth: that a committee of investors, no matter how intelligent or well-intentioned, is a recipe for financial disaster. He had studied the market history. He had read every page of Benjamin Graham's The Intelligent Investor. He understood that the greatest enemy of the long-term investor is not a bad market, but a bad temperament, driven by the emotional whims of the moment. By instituting this rule, he wasn't seizing power for his ego, he was building a firewall. A firewall between the rational, calculated world of value investing and the chaotic, fear and greed-driven world of market sentiment. He was protecting his partners not from the market, but from themselves. He knew that if the market dropped 20%, his phone would ring. His aunt would be worried. His roommate would have read a terrifying headline in the newspaper. They would urge him to sell, to get safe, to do something. And doing something, in a panic, is almost always the wrong thing. This rule was a preemptive strike against that panic. It was a contract that said, you are not hiring a stock picker, you are hiring a mindset. You are not investing in stocks, you are investing in a process. And that process requires a single, disciplined hand on the wheel. The early partners who agreed, people like his college roommate Chuck Peterson who put in $20,000, weren't just betting on Buffett's stock-picking ability. They were betting on his character and his framework. They were accepting that in this specific domain, his expertise superseded their anxiety. It was a monumental act of faith, but it was a faith grounded in the logic he presented. He was creating a structure that is now mirrored in the most elite echelons of finance, from private equity to hedge funds, where limited partners cede control to a general partner. But he did it first, in a living room, with the people he loved most. The underlying psychological principle at play here is a powerful defense against several cognitive biases that cripple the average investor. The most prominent is herd bias, or the powerful instinctual urge to follow the actions of a larger group. When the market is soaring, the herd buys, driven by FOMO, the fear of missing out. When the market is crashing, the herd sells, driven by panic. Herd bias feels safe because it's validated by the actions of others, but it is the antithesis of intelligent investing, which demands buying when others are fearful and selling when others are greedy. Buffett's rule of absolute authority effectively disbands the herd before it can even form. By cutting off communication and removing the partner's ability to influence decisions, he insulated the partnership's capital from the emotional contagion of the market. He could operate in a vacuum of pure logic and analysis, immune to the panicked phone calls and the euphoric tips that would inevitably come his way. Secondly, this rule brilliantly manages the Dunning-Kruger effect among his investors. This cognitive bias describes the tendency for people with low ability in a specific area to overestimate their competence. In finance, this is rampant. An investor might read a few articles, watch a market news channel, and suddenly believe they have a sophisticated understanding of a company or the economy. They might hear a hot tip from a neighbor and believe it's a sure thing. Buffett's rule was a gentle but firm way of stating, with all due respect, in this particular domain, you don't know what you don't know. It forced his partners to acknowledge their own limitations and to trust the specialist they had chosen. It prevented them from meddling, from trying to help with their own well-intentioned but likely disastrous ideas. This structure also forces a resolution of cognitive dissonance. Cognitive dissonance is the mental discomfort experienced when holding two or more contradictory beliefs or values. When an investor gives money to a manager but doesn't fully trust their strategy, they are in a state of dissonance. This discomfort often leads them to pull their money at the first sign of trouble to resolve the conflict. Buffett's all-or-nothing proposition forced his partners to resolve this dissonance up front. Either you believe in this rational, long-term approach completely and cede control, or you do not invest. There was no middle ground. You couldn't be half pregnant. This pre-commitment, this upfront resolution of dissonance, created a much more stable and resilient investor base, one that was psychologically prepared to weather the storms he knew were inevitable in any long-term investing journey. This single rule, therefore, wasn't about power. It was a sophisticated piece of psychological engineering designed to create the optimal environment for rational decision-making in a fundamentally irrational world. So how do we translate this into an applied mental model for our own lives? We are not all running investment partnerships, but we are all the CEO of our own financial future. The blueprint is to create what we can call a personal investment constitution. This is a written document, a declaration of your own financial governance. It is the act of formalizing your investment strategy and, crucially, your own chain of command. Step 1. Define your role as the portfolio CEO. You must formally appoint yourself as the sole executive decision-maker for your investments. This isn't just a mental exercise. Write it down. I, your name, am the sole authority for all buy, sell, and hold decisions within my investment portfolio. This simple act creates a powerful psychological shift. It moves you from being a passive participant in your finances to the active, accountable leader. Step 2. Establish your board of directors and define their role. Your board might include a spouse, a trusted mentor, or a qualified financial advisor. However, your constitution must explicitly state their function. The board's role is purely advisory. They can offer perspective, challenge your assumptions, and act as a sounding board. But the Constitution must state, the board of directors has no voting power on executive decisions. The final authority rests with the CEO. This allows you to benefit from diverse perspectives without succumbing to decision-making by committee. You listen, you learn, but then you go into your office, close the door, and make the final call yourself. Step 3 is the most critical. Draft the "thou shalt not" commandments. This is where you pre-commit to behavior that will protect you from your future, emotional self. These are your personal ground rules. They should be specific and absolute. For example, I shall not sell a core holding solely because the market has declined by more than 20%. I shall not purchase a security based on an unsolicited tip from a non-professional source. I shall not check my portfolio's value more than once per week. I shall not deviate from my established asset allocation plan due to short-term market news. These commandments are written when you are calm, rational, and long-term oriented. They serve as a binding contract with your future self, the one who will be panicked, greedy, or overconfident. When the market is in turmoil, you don't have to think. You just have to obey the Constitution you wrote when you were at your wisest. This document is your shield. It formalizes your investment philosophy and creates the discipline that is the hallmark of financial success. This is how you implement Buffett's rule of absolute authority in your own life, creating a bulwark against the emotional chaos that derails most retail investor guides. To truly appreciate the genius of this first rule, we must examine its antithesis, the path of the 99%. This is the path of the financial amateur, the investor who operates without a constitution, without a clear chain of command. Their decision-making process is a chaotic mess of external inputs and emotional reactions. They practice what can be called investing by committee, where the committee members are a random assortment of their brother-in-law, a talking head on a financial news network, a popular influencer on social media, and a handful of anonymous strangers on a Reddit forum. Each voice offers a conflicting opinion, a different strategy, a new, hot stock. The result is not wisdom of the crowd, it is madness. Imagine this investor. They hear from their brother-in-law that tech is the future, so they pile into speculative tech stocks at the peak of a bubble. Then, they turn on the news and hear a pundit screaming about an impending recession, so they panic and sell those same stocks at a 30% loss. A week later, a YouTuber they follow posts a video about the inevitable rise of crypto, so they take their remaining capital and move it into a highly volatile, speculative asset they don't truly understand. Their portfolio is not the result of a coherent investment strategy. It is a disjointed scrapbook of other people's opinions. There is no CEO. There is only a frantic switchboard operator, patching through whichever call is the loudest and most urgent. This approach is not just ineffective, it is financially catastrophic. It guarantees that the investor will buy high, driven by the social proof of the crowd, and sell low, driven by the collective panic. They are perpetually whipsawed by the market's moods because they have no internal anchor, no foundational rules to cling to. Consider the dot-com bubble of the late 1990s. The 99% path was to believe that this time is different, that traditional valuation metrics no longer applied. It was to listen to the committee of neighbors and news anchors who promised endless riches from companies with no profits and no plausible business models. The person with a personal constitution, with a rule of absolute authority, grounded in value investing principles, would have been forced to abstain to look like a fool for months or even years. But when the bubble burst, their discipline was vindicated, as the committee-driven investors saw their portfolios evaporate. The path of the 99% is a path of constant reactivity. It is exhausting, stressful, and ultimately, a losing game. Buffett's first rule is a radical rejection of this chaos. It is a declaration that in the world of investment management, a benevolent dictatorship based on rational principles will always, over the long term, outperform a democracy of opinion driven by fear and greed. The direct financial connection of this principle is profound and can be measured on your account statement. The rule of absolute authority directly prevents the two most destructive behaviors in portfolio management: overtrading and emotional whipsawing. Let's quantify this. Studies have shown that the average investor consistently underperforms the market indices, and the primary reason is not poor stock selection, but poor timing, driven by emotional decisions. They buy after a period of strong performance, buying high, and sell after a downturn, selling low. Each of these decisions has a tangible cost. First, there are transaction costs. Every time the committee-driven investor panics and reallocates their portfolio, they are paying brokerage fees. While these may seem small, they act as a constant drag on performance, a small leak that can sink a great ship over decades. Second, and far more significant, are the tax consequences. When you sell a winning position in a taxable account after holding it for less than a year, you pay short-term capital gains tax, which is taxed at your ordinary income rate, a much higher rate than the preferential long-term capital gains rate. The investor who constantly churns their portfolio based on news and tips is effectively giving a massive chunk of their potential returns directly to the government. A disciplined, CEO-driven investor who follows their constitution and holds quality assets for the long term minimizes this tax drag, allowing their capital to compound much more efficiently. But the most significant financial impact is the preservation of the compounding engine. Let's imagine a hypothetical two investors, each starting with $100,000. Investor A follows the path of the 99%, getting scared out of the market during major downturns. In the 2008 financial crisis, they sell everything and only get back into the market in 2010 after they feel safe again. In the 2020 COVID crash, they do the same. Investor B has a personal constitution with a "thou shalt not panic sell" commandment. They hold firm through the downturns. Over a 20-year period, the difference in their final portfolio value will not be a few percentage points, it will be staggering. Investor B's portfolio could easily be double or triple the size of Investor A's. Investor A didn't fail because they picked bad stocks. They failed because they had a broken governance structure. They let the committee of fear and greed make their decisions. The rule of absolute authority is the bedrock of long-term financial discipline. It transforms your portfolio from a weather vane, spinning in the winds of market sentiment, into a lighthouse built on a solid foundation, weathering every storm and staying true to its purpose. This single rule is the difference between participating in the market's long-term wealth creation and being a victim of its short-term volatility. The second pillar of Buffett's framework was a radical redefinition of success itself. In his ground rules, he explicitly told his partners, "I will not be judging my performance against the market on a year-to-year basis." This was heresy. In the financial world, everything is benchmarked quarterly, annually, sometimes even monthly. But Buffett knew this was a fool's game, a recipe for short-term thinking and strategic errors. Instead, he proposed a different yardstick. His goal was to beat the Dow Jones Industrial Average by an average of 10 percentage points per year, but this would be measured over a rolling 3-year period. Furthermore, he emphasized that in a roaring bull market he would likely underperform. His strategy of buying undervalued, safe securities would naturally lag the high-flying speculative stocks. His true value, he explained, would be demonstrated in down or flat markets. In those years, his goal was to lose less money than the index, to protect their capital on the downside. This rule was a masterclass in behavioral finance, designed to calibrate his partners' expectations to the reality of a value-oriented investment philosophy and to free himself to make decisions for the long term. The foundational anecdote for this pillar is less a single moment and more of a continuous, decade-long conversation Buffett had with his partners through his annual letters. But its origin lies in that 1956 meeting. When he laid out this rule about performance measurement, he was preemptively diffusing the most common source of conflict between a money manager and an investor: short-term underperformance. Imagine telling your investors that you fully expect to look like a fool during the best of times. It takes incredible confidence and foresight. He was essentially saying, "We will not be participating in the speculative manias." When everyone else at the cocktail party is bragging about the fortune they made on some hot tech stock, we will be sitting quietly, perhaps even with results that look boring or substandard. Do not compare our journey to theirs. This was put to the test during the bull market of the late 1950s and 60s. There were individual years where the Buffett partnership did in fact lag the Dow. For example, in 1958, the partnership returned a stellar 40.9%, but the Dow was up 38.5%. While he beat it, it wasn't by a massive margin in a hot market. But then you look at a down year, like 1957. The Dow was down 8.4%. The Buffett partnership was up 10.4%. That's a nearly 19-point swing of outperformance. He was proving his thesis in real time. He was delivering on the exact promise he made in his ground rules. By setting the metric to a 3-year rolling average, he gave himself the intellectual and emotional breathing room to execute his strategy. He didn't have to worry about a single bad year causing a run on the bank, with partners pulling their capital. He could buy a deeply undervalued company and wait patiently for 2 or 3 years for its value to be recognized by the market, without the pressure of showing a big gain in the next quarter's report. He was playing a different game, a longer game, and he forced his partners to keep score using his clock, not Wall Street's. This rule on measuring what matters was the key that unlocked his ability to practice true, patient, long-term value investing. He wasn't just managing money, he was managing the expectations and emotions of the people whose money he was stewarding, which is arguably the more difficult and more important task for any investment professional. The underlying psychological principle behind this custom benchmark is a direct assault on 2 powerful cognitive biases: myopia and regret aversion. Myopic loss aversion is the tendency for people to feel the pain of a loss more acutely than the pleasure of an equivalent gain, and to evaluate their outcomes over very short time horizons. A traditional annual performance review feeds directly into this bias. If an investor sees their portfolio is down for the year, the loss part of their brain lights up, triggering anxiety and a desire to make a change, even if the long-term strategy is perfectly sound. Buffett's 3-year rolling average is a brilliant psychological hack to combat this. It forces a longer time horizon. A single bad year gets smoothed out by 2 other years, dramatically reducing the emotional volatility of the performance data. It reframes the partner's perspective from "how did we do this year" to "how are we doing on our multi-year journey." This small change in the reporting cadence has a massive impact on investor behavior, promoting patience and discouraging knee-jerk reactions. Secondly, this rule mitigates regret aversion. This is the tendency to avoid making decisions that one might regret in the future. In investing, this often manifests as a fear of underperforming one's peers or a popular benchmark. If the S&P 500 is up 30% and your portfolio is only up 15%, you feel regret. You feel like you missed out. This feeling can lead investors to abandon a sensible, conservative strategy in favor of chasing whatever is currently popular and high-flying, often just as it's about to peak. Buffett addressed this head-on by stating his intention to underperform in frothy markets. He was giving his partners permission, in advance, to not feel regret. He was inoculating them against the inevitable envy they would feel when hearing about others' speculative wins. He framed downside protection in flat or down markets as the true measure of success. This is a profound psychological insight. He shifted the definition of a win from making the most money in a good year to losing the least money in a bad year and compounding steadily over the long haul. By controlling the scorecard, he controlled the emotional tenor of the game, creating a more rational and sustainable environment for wealth building. To apply this pillar, we must create our own personalized scorecard, a mental model for measuring what truly matters in our own financial lives. This is the personal performance framework. It's about consciously choosing your benchmarks and your time horizons, rather than passively accepting the ones force-fed to you by the financial media. Step 1. Define your primary financial objective. Why are you investing in the first place? It's not to beat the market. Is it to achieve financial independence by age 55? Is it to fund your children's education in 15 years? Is it to generate a specific amount of annual income in retirement? Your primary objective is your true north. Write it down in specific, measurable terms. For example, my goal is to grow my portfolio to $2 million by 2045 to fund a retirement that requires $80,000 in annual withdrawals. Step 2. Choose a relevant benchmark, not a generic one. If you are a 60-year-old retiree with a portfolio designed for capital preservation and income, it is utterly insane to measure your performance against the NASDAQ 100. A more appropriate benchmark might be a blended index of 40% stocks and 60% bonds, or even just your own target rate of return, like inflation plus 4%. If you are a young investor in your accumulation phase, perhaps the S&P 500 is a reasonable benchmark, but you must commit to the right time horizon. Step 3. Explicitly set your evaluation horizon. This is where you directly apply Buffett's genius. Write in your personal investment constitution. I will evaluate the performance of my overall strategy not on an annual basis, but on a rolling 3-year or even 5-year basis. This commitment frees you from the tyranny of short-term noise. It allows you to stick with a sound strategy even if it goes through a period of underperformance, which every single strategy eventually does. Step 4. Define failure and success on your own terms. Success is not beating the market every year. Success is being on track to meet your primary financial objective. Write this down. Success is defined as my 5-year average return, keeping me on the glide path to achieving my stated goal of your goal. This reframes the entire exercise. You are no longer competing against a random index on a short-term basis. You are executing a long-term plan to win your own game, the only game that actually matters. This framework transforms you from a spectator, nervously watching the daily market scoreboard, to a pilot, calmly flying at 30,000 feet, focused on the long-term destination, knowing there will be patches of turbulence along the way. The antithesis, the path of the 99%, is to be a slave to the annual benchmark. This is the default setting for most retail investors. They log into their brokerage account in January and judge their entire financial acumen on whether their personal rate of return was higher or lower than the S&P 500's return for the previous calendar year. This seemingly benign habit has disastrous consequences. It forces short-term thinking and encourages strategy hopping. Let's say an investor has chosen a solid, dividend-focused, value-oriented strategy. In a year like 2021, when speculative growth stocks were soaring, their value strategy might have returned a respectable 15%, but the S&P 500, driven by a handful of mega-cap tech stocks, was up nearly 27%. The 99% investor sees this gap and feels like a failure. They feel regret. Their brother-in-law, who owns all the popular tech stocks, is bragging at the family barbecue. The financial media is filled with stories of tech billionaires. So what do? They abandon their sound, long-term strategy and reallocate their portfolio into the very growth stocks that have just had a massive run-up, buying them near their peak. Then, the next year, the market sentiment shifts. The bubble in speculative tech deflates, and those stocks crash by 50%, while the boring, dividend-paying value stocks they just sold hold up relatively well. They have now managed to perfectly execute the buy high, sell low maneuver, not because they are unintelligent, but because they were using the wrong scorecard. They were playing a one-year game, when wealth is built over a 30-year game. This annual performance obsession also leads to what's called style drift. A manager or an individual investor starts with a clear philosophy, say value investing, but after a few years of underperforming a different style, like growth investing, they start to bend their own rules. They start to buy companies that are a little more expensive, a little more speculative, trying to catch up to the benchmark. Over time, their portfolio no longer reflects their original sound philosophy. It becomes a muddled mix of strategies, an incoherent mess driven by a fear of falling behind in the short term. The 99% path is a frantic chase, constantly looking in the rearview mirror at last year's winners. Buffett's approach is to stare resolutely ahead, through the windshield, at the long road toward his ultimate destination, knowing that the scenery will change and that some stretches of road will be slower than others. The direct financial connection of this rule is the preservation and enhancement of long-term compounding. The financial cost of using the wrong benchmark is the constant interruption of the compounding process. Every time an investor abandons a strategy due to short-term underperformance, they are effectively resetting their compounding clock. They sell assets, incurring taxes and transaction costs, and then buy into a new strategy, often at an inopportune time. This friction, this constant churn, is a massive hidden tax on their wealth building. Let's quantify it with a simple example. A disciplined value investing strategy might, over a 30-year period, generate an average annual return of 10%. A growth-oriented strategy might also average 10%, but with much more volatility, huge gains in some years, big losses in others. The 99% investor who chases performance might start in value, switch to growth after it has a big run, then switch back to value after growth crashes. Their blended return from all this switching will not be 10%. Due to bad timing, taxes, and fees, their actual realized return might be closer to 5 or 6%. On a $100,000 investment over 30 years, the difference between a 10% compound return and a 6% compound return is astronomical. The 10% portfolio grows to over $1.7 million. The 6% portfolio grows to just under $575,000. That is over $1 million in lost wealth, vaporized not by bad markets but by bad behavior, which was fueled by using the wrong measurement system. By establishing a proper, long-term personal performance framework, you are building a financial dam. You are capturing the full power of the river of compounding, rather than letting it leak away through the cracks of short-term emotional reactions. This rule turns your balance sheet from a reflection of the market's annual whims into a testament to your own disciplined long-term plan. It ensures that the most powerful force in the financial universe, compound interest, is working for you, not against you. The third pillar in Buffett's foundational architecture was the non-negotiable principle of skin in the game. It was simple, direct, and profoundly powerful. In his ground rules, he made it clear to his partners that he would have virtually his entire net worth invested right alongside theirs in the very same securities. He wasn't just managing their money, he was managing our money. His financial fate was inextricably linked to theirs. If they lost money, he lost a proportionally massive amount of his own fortune. If they prospered, he would prosper. This wasn't a clever marketing tactic. It was the ultimate alignment of interests. It was a declaration that his advice was not cheap talk. He was eating his own cooking, and his partners knew that his focus, his diligence, and his prudent risk management were guaranteed. because his own financial survival was on the line every single day. The foundational anecdote for this pillar unfolds not in a single moment, but over the entire life of the Buffett partnerships, from 1956 to 1969. When he started that first partnership with $105,000 from family and friends, Buffett himself put in only $100. This sounds counterintuitive, but it was a deliberate, temporary choice. He was, at the time, already managing the money of his family in separate, informal arrangements. The $100 was the legal minimum to establish himself as the general partner of the new, formal entity, the Buffett Associates, Limited. However, his life savings, which at the time amounted to a significant sum he had built through his early ventures and work with Benjamin Graham, were already invested in the exact same way. He quickly consolidated everything. By the next year, 1957, when he had formed multiple partnerships that would eventually be consolidated, he had over 90% of his personal net worth invested in them. He told his partners, "I have put my entire net worth into the partnership. My wife and I and our children will have our financial future determined by the same results that you do." This was a stunning commitment. Think about the average mutual fund manager or financial advisor today. They might manage billions of dollars, but their personal investments are often a complete black box. They get paid a salary and a bonus whether their clients' portfolios go up or down. Their skin is, relatively speaking, not in the game. Buffett rejected this model from day one. He structured his compensation in a way that reinforced this alignment. He took no management fee. He didn't get paid a percentage of assets every year, a practice that rewards managers simply for gathering assets, not for generating returns. His compensation was based purely on performance. He took 25% of any profits above a 6% annual hurdle rate. This meant that if the partnership didn't earn at least 6% for his partners, he got paid nothing. Zero. This structure ensured that he was only rewarded for creating real, substantial value for his investors. It made him a true partner, not just a hired hand. This commitment had a profound effect on his decision-making. He wasn't taking wild risks, hoping for a big bonus. He was managing the money with the intense conservatism of someone whose own family's security depended on it. He famously said, "Rule number 1, never lose money. Rule number 2, never forget rule number 1. This wasn't a clever slogan. It was the natural operating philosophy of a man who stood to lose everything if he was wrong. The underlying psychological principle at the heart of skin in the game is the concept of incentives and the associated power of loss aversion. The theory of incentives is one of the most fundamental in economics and psychology. People respond to incentives. What Buffett did was create the most perfectly aligned incentive structure imaginable. His personal financial incentive was 100% aligned with the financial incentive of his partners, to achieve the highest possible risk-adjusted return over the long term. This structure eliminates what is known in business as the, quote, principal-agent problem. The principal-agent problem occurs when one person, the agent, in this case the money manager, is supposed to act on behalf of another, the principal, the investor, but has a personal incentive to act in a way that may not be in the principal's best interest. For example, a broker who earns a commission for every trade has an incentive to encourage frequent trading, even if a buy-and-hold strategy would be better for the client. Buffett's structure completely solved this problem. He had no incentive to do anything other than what was best for the partnership as a whole, but the psychology goes deeper, tapping into loss aversion. As we've discussed, the pain of a loss is psychologically far more powerful than the pleasure of an equivalent gain. By having his entire fortune in the partnership, Buffett wasn't just motivated by the potential for gain, he was intensely motivated by the fear of loss. This is a crucial distinction. A manager chasing a bonus might take on excessive risk to hit a home run. A manager trying to protect his own life savings will be far more focused on avoiding strikeouts. This deep-seated aversion to losing his own money forced a level of due diligence, a demand for a margin of safety in every investment that a salaried manager might never feel. It made him a fundamentally better, more prudent investor. When you have skin in the game, your analysis is sharper, your conviction is tested more rigorously, and your patience is fortified. You are no longer dealing with abstract percentages on a screen. You are dealing with the tangible reality of your own future. This principle creates an environment of earned trust. The partners didn't need to question his motives, because his motives were transparently the same as theirs. To apply this powerful principle to our own financial lives, we must adopt the mental model of the owner-operator. Even if you are investing in public markets, you must shift your mindset from that of a renter of stocks to an owner of businesses. Skin in the game for a personal investor isn't about managing other people's money. It's about ensuring your own actions and beliefs are deeply and genuinely aligned. Step 1. Conduct an alignment audit. Look at your portfolio. For every single position, ask yourself, do I understand this business well enough that I would be comfortable putting 10% of my net worth into it and holding it for 10 years if the stock market closed tomorrow? If the answer is no, you don't have true skin in the game, you're just renting a ticker symbol. This audit forces you to clear out the speculative clutter, the hot tips, the things you bought without real conviction. Step 2. Adopt a concentrated conviction approach. Instead of diversifying into 100 different stocks you barely know, follow Buffett's early partnership model. He often held very concentrated positions in a handful of companies he knew inside and out. For the personal investor, this might mean having 80% of your equity portfolio in 10 to 15 businesses that you have deeply researched and in which you have unshakable conviction. This isn't about being reckless. It's about ensuring your capital is deployed only in your highest conviction ideas. It forces you to do the work. It forces you to have real skin in the game for each position. Step 3. Put your money where your mouth is, literally. Many people have a play portfolio for speculation and a serious portfolio for retirement. The skin in the game principle suggests this is a mistake. Your investment philosophy should be robust enough to apply to all of your capital. If you believe in long-term, low-cost index fund investing, your entire portfolio should reflect that. If you believe in deep value investing, it should be applied consistently. Having a Vegas account is an admission that you don't fully trust your own core strategy. Align all of your capital with your stated philosophy. This creates integrity in your process. You are eating your own cooking, which will make you a much better cook over time. This owner-operator model ensures that your financial fate is tied directly to the quality of your own thinking and research, the ultimate form of personal financial accountability. The antithesis, the path of the 99%, is to operate with no real skin in the game. This manifests as playing with money. The average retail investor often treats the stock market like a casino. They buy stocks based on flimsy reasoning, a cool product, a catchy name, a story they heard on the news. They have no deep understanding of the business's financials, its competitive advantages, or its long-term prospects. They are renters, not owners. Because they have no real conviction, no intellectual skin in the game, their commitment is shallow. When the stock price drops 15%, they don't see it as an opportunity to buy more of a great business at a discount. They see a losing bet. They panic and sell because their position was never grounded in a deep belief in the underlying asset. They are simply gambling on price movements. This lack of skin in the game is also rampant in the financial advisory world. Consider the advisor who recommends a portfolio of expensive, actively managed mutual funds. They sound confident, they use sophisticated jargon, but ask them if their own personal money is invested in those same high-fee funds. Often the answer is no. They are selling a product they themselves would not buy. They are not eating their own cooking. This creates a fundamental misalignment of interests. Their incentive is to sell the product that makes their firm the most money, not necessarily the one that is best for the client. The 99% path is to trust advice from those who have no consequences for being wrong. It's listening to the TV pundit who can recommend a stock on Monday and never be held accountable if it collapses on Friday. It's following anonymous accounts on social media who can tout a speculative asset and then simply disappear when it goes to zero. The path of the 99% is a world of cheap talk. where advice is abundant but accountability is scarce. Buffett's principle is a radical filter. It says do not listen to anyone's opinion unless they are exposed to the consequences of that opinion. It demands that you either invest with people whose financial fate is tied to yours, or, when investing for yourself, to only take positions where you have done the work to create real, intellectual, and financial conviction. The direct financial connection of the skin in the game principle is a dramatic improvement in both risk management and long-term returns. The financial impact is twofold. First, it leads to superior business and investment selection. When your own capital is on the line, your standards for what constitutes a worthy investment go up exponentially. You are no longer looking for a hot stock. You are looking for a durable, profitable enterprise at a reasonable price. This focus on quality and value, driven by the self-preservation instinct, naturally leads to a portfolio of more resilient businesses. This is reflected in the balance sheet of your portfolio. It will tend to have companies with lower debt levels, higher profit margins, and more sustainable competitive advantages. Over the long term, a portfolio of such businesses will almost inevitably outperform a portfolio of speculative, low-quality companies. Second, and more importantly, it fundamentally alters your behavior during market downturns. This is where the real money is made or lost. The investor with no skin in the game, who bought a stock on a flimsy tip, will see a 30% market crash as a catastrophe. They will sell in a panic to, quote, cut their losses. The owner-operator, the investor with deep conviction and skin in the game, sees that same 30% crash as a fire sale. They understand the long-term value of the businesses they own. They are not shaken out by the price decline. They are emboldened by it. It is an opportunity to increase their ownership stake in wonderful companies at bargain prices. This behavior, buying, not selling, when there is blood in the streets, is the single greatest determinant of long-term investment success. Over an investor's lifetime, the returns generated by having the courage to deploy capital during panics will dwarf the returns from almost any other activity. That courage doesn't come from bravado, it comes from genuine conviction. And genuine conviction is forged in the fire of having your own skin in the game. This principle, therefore, directly translates into a higher quality portfolio and a behavioral pattern that allows you to exploit market volatility rather than become a victim of it, leading to a vastly superior financial outcome over time. The fourth pillar of Buffett's original architecture was the principle of a shared philosophy. It wasn't enough for his partners to give him their money and their trust. He insisted they also give him their understanding. He didn't want silent partners. He wanted educated partners. From the very beginning, he committed to writing a detailed annual letter to his investors. This was not a glossy marketing brochure filled with corporate jargon. It was a masterclass in his investment thinking. He explained his failures with more clarity than his successes. He broke down his concept of value investing, his search for a margin of safety, and his focus on business fundamentals. He was, in effect, forcing his partners to go to school. He wanted them to understand the why behind his actions, not just the what. This wasn't for their entertainment. It was a crucial part of his strategy. By educating his partners, he was building a more resilient, more stable, and more rational investor base. He was ensuring that everyone in the boat was rowing in the same direction, guided by the same philosophical map. The foundational anecdote that perfectly illustrates this pillar is the story of his 1967 annual letter, in which he discussed the changing market environment. By the late 1960s, the stock market had become increasingly speculative, a go-go era that felt frothy and disconnected from underlying business value. The kind of cheap, statistically backed cigar butt investments that he and his mentor Ben Graham had built their careers on were becoming incredibly scarce. Instead of pretending everything was business as usual, Buffett used his letter to have a frank, educational conversation with his partners. He wrote, "I feel it is my duty to report to you that the reading on my Geiger counter of investment opportunities is now down to a very low level." He went on to explain, in detail, why the current environment was hostile to his specific value investing strategy. He talked about the flood of money into mutual funds, the focus on short-term performance, and the speculative fervor that had gripped Wall Street. He then did something extraordinary. He told them he was struggling to find things to buy, and that future returns would likely be much lower than their historical results. He even said, "I am out of step with present conditions. I am likely to continue to be out of step." This is the polar opposite of what almost any money manager would do. Most would try to spin the situation, to project confidence, to assure investors that they could adapt and win in any environment. Buffett did the opposite. He was transparent, he was humble, and most importantly, he was educational. He was treating his partners like true partners, not like sales prospects. The result of this radical transparency was not a panicked exodus of investors. It was the exact opposite. His partners, having been educated for over a decade by his letters, understood the philosophy. They understood that value investing is cyclical and that the correct response to a speculative, overpriced market is patience and discipline, not a reckless change in strategy. They trusted him more, not less, because he was honest about the challenges. This letter, and others like it, cemented the partnership not as a collection of individual financial interests, but as a community unified by a shared investment philosophy. 2 years later, in 1969, believing the market was profoundly overvalued and that he could no longer perform to his standards, he made the momentous decision to liquidate the partnership and return all the capital to his partners. He did this at the peak of a bull market, an act that would have been impossible without the decade of philosophical education he had provided. His partners understood the why, and it allowed him to make one of the greatest market timing calls in history, protecting their capital from the brutal bear market that followed in the early 1970s. The underlying psychological principle that makes this shared philosophy so powerful is the creation of what is called in-group/out-group dynamics, but used for a positive, rational purpose. By constantly teaching his specific philosophy of value investing, Buffett was drawing a clear line. There was the in-group, us, the partners, who think about stocks as pieces of a business, who demand a margin of safety, who are patient and long-term oriented. And then there was the out-group, them, the rest of Wall Street, the speculators, the short-term traders, the people chasing fads. This creates a powerful sense of collective identity and reinforces the desired behaviors. When the out-group is going wild over some new tech stock, the in-group feels a sense of pride in their discipline and their contrarian stance. It transforms abstaining from a mania, from an act of missing out into an act of intellectual superiority and group solidarity. This principle also heavily leverages the commitment and consistency bias. This bias states that once we make a choice or take a stand, we will encounter personal and interpersonal pressure to behave consistently with that commitment. By reading Buffett's letters and implicitly agreeing with his philosophy year after year, the partners were making a series of small psychological commitments. They were committing to the idea that patience is a virtue, that price is what you pay, and value is what you get. When a moment of crisis or temptation arrived, this long history of commitment made it much harder for them to suddenly break faith and demand a change in strategy. They were psychologically invested in the philosophy, not just financially invested in the portfolio. It would be inconsistent with their established identity as a Buffett partner to panic and sell during a downturn. This deep philosophical alignment creates an incredibly strong psychological anchor, keeping the entire partnership grounded during periods of market insanity. It's a form of mass inoculation against the viruses of fear and greed. To apply this to our own lives, we must go beyond simply writing a personal investment constitution. We must actively engage in a process of philosophical self-education. The mental model here is the Investor's Manifesto. This is a living document, longer and more detailed than your constitution, where you articulate not just your rules, but your core beliefs about how markets work and how wealth is built. Step 1. Write your first principles. What do you believe to be the fundamental truths of investing? For example, I believe the stock market is, in the short run, a voting machine, but in the long run, a weighing machine. I believe that the biggest risk is not market volatility, but the permanent loss of capital. I believe that the most powerful force in finance is compound interest, and my primary goal is to not interrupt it. These are the foundational beliefs upon which your entire strategy will be built. Step 2. Identify your intellectual mentors. Whose investment philosophy do you most admire? Is it Warren Buffett? Is it John Bogle, the founder of Vanguard? Is it Peter Lynch? Is it Howard Marks? You need to consciously choose your school of thought. Then, you must commit to studying their work deeply. Read their books, their shareholder letters, their interviews. Your goal is to be able to articulate their philosophy in your own words. This process of deep study solidifies your own beliefs and gives you a proven framework to fall back on. Step 3. Create a decision diary. Every time you make a significant investment decision, a buy or a sell, you must write down in your investor's manifesto not just what you did, but why you did it, and how that decision aligns with your stated first principles and the teachings of your intellectual mentors. For example, today I bought shares of Company X at $50. My mentor, Ben Graham, teaches to demand a margin of safety. Based on my analysis of its assets and earning power, I calculate its intrinsic value to be $80 per share. This purchase is consistent with my first principle of buying wonderful companies at fair prices. This diary is incredibly powerful. When you are feeling uncertain in the future, you can go back and read the clear, rational thinking you employed when you made the initial decision. It prevents emotional amnesia and reinforces your commitment to your long-term philosophy. This manifesto makes your investment philosophy explicit, turning it from a vague notion into a concrete and actionable guide. The antithesis is the philosophical nomad. This is the investor who wanders aimlessly through the marketplace of ideas, picking up a piece of a strategy here, a tactic there, with no unifying belief system. They have no core philosophy. One week, they are a day trader, trying to scalp pennies based on technical chart patterns. The next week, they read an article about index funds and decide to become a passive investor. A month later, a friend tells them about options trading, and they dive into that, hoping for quick profits. Their approach is a chaotic mishmash of contradictory ideas. They are a value investor on Monday, a growth investor on Tuesday, and a momentum trader on Wednesday. Because they have no philosophical anchor, they are incredibly susceptible to marketing hype and the shiny object syndrome. Every new investment product, every new guru, every new strategy that promises easy riches will pull them off course. They are constantly starting over, never allowing any single strategy the time it needs to actually work. The philosophical nomad's portfolio reflects this chaos. It's a collection of assets that make no sense together. A few blue-chip stocks, some speculative cryptocurrencies, a leveraged ETF, and a handful of mutual funds they bought years ago and forgot about. There is no coherence, no purpose. They are doomed to underperform, not because any single idea they tried was necessarily bad, but because they never committed to one long enough for it to bear fruit. They mistake motion for progress. Buffett's approach is the complete opposite. It is a deep, lifelong commitment to a single, coherent philosophy, constantly refined and improved, but never abandoned. The path of the 99% is to be a jack of all trades and a master of none. The path to wealth is to become a master of one sound philosophy and to execute it with unwavering discipline for a very long time. The direct financial connection of having a shared, or in our case, a deeply held personal philosophy is immense. It directly enables the two most important wealth-building actions: holding for the long term and buying during downturns. Let's look at the balance sheet impact. A clearly defined investment philosophy naturally leads to a more concentrated, high-conviction portfolio. Instead of owning 100 random stocks, you might own 20 businesses you know intimately. This concentration, when based on a sound philosophy, is what generates market-beating returns. Diversification can protect you from ignorance, But concentration is what creates real wealth, and you can only be concentrated if you have a philosophical basis for your conviction. This is reflected financially in a higher active share and the potential for significant alpha or returns above the market benchmark. Furthermore, a strong philosophy dramatically reduces costly behavioral errors. Consider the financial crisis of 2008. The philosophical nomad, seeing their portfolio down 40%, panicked. Their only thought was, make the pain stop. They sold everything near the bottom, crystallizing their losses and turning a temporary paper decline into a permanent loss of capital. The investor with a deeply ingrained value investing philosophy saw the same 40% decline and thought, this is the opportunity of a lifetime. Their philosophy told them that fear was their friend, and that the market was offering once-in-a-generation bargains on world-class businesses. They put more money to work. The financial divergence between these two paths over the next decade is almost impossible to overstate. The first investor locked in devastating losses and likely stayed out of the market for years, missing the recovery. The second investor generated life-changing returns. The difference was not intelligence or access to information. It was the presence of a robust, deeply held investment philosophy that allowed for rational action in the face of absolute terror. This philosophy is not a luxury, it is a financial necessity. It is the intangible asset that generates the most tangible returns of all, by allowing you to harness the power of compounding and to turn the market's greatest moments of fear into your greatest moments of opportunity. The fifth and final pillar of Buffett's foundational creed was the principle of radical honesty about risk. In the world of finance, where optimism is the product and guarantees are the holy grail, Buffett began his partnership with a stark and uncomfortable truth. He stated in his ground rules, in no uncertain terms, that there would be years where they would lose money. He offered no promises of positive returns. He explicitly told his partners that his style of investing, concentrating capital in a few undervalued securities, was inherently riskier and more volatile than owning a diversified mutual fund. He explained that their returns would be lumpy and unpredictable in the short term. He was selling not the promise of a smooth ride, but the probability of a superior destination, with the full disclosure that the journey would be turbulent. This was not a legal disclaimer buried in fine print. It was a headline principle. It was a filter, designed to attract the right kind of investor and repel the wrong kind, ensuring that his partners were psychologically prepared for the realities of long-term investing from the very first day. The foundational anecdote that brings this pillar to life is not about a specific investment, but about the very structure of his famous fee arrangement. As we discussed, he took 25% of the profits above a 6% hurdle, but there was another, crucial component to this rule that is often overlooked: the high water mark. This provision meant that if the partnership had a losing year, he would earn no fee in subsequent years until all of those losses were first recovered. Imagine the partnership value fell by 10% in 1 year. The next year, even if he generated a 15% return, he would not be paid on that full amount. The first 10% of gains would simply be used to make his partners whole again, to get them back to their, quote, high water mark. He would only be eligible to earn a fee on the 5% of profit above that previous peak. This is an incredibly partner-friendly structure, and it was a tangible demonstration of his principle of no guarantees. It was his way of saying, we will have losing years. It is inevitable. And when we do, I will work for free until I have earned your money back for you. This wasn't just talk. It was a legally binding commitment that put his own compensation on the line. This structure was tested. While the Buffett partnerships had an astonishing record, they were not immune to down years. By openly and honestly discussing the potential for loss from the outset, and backing it up with a fee structure that penalized his own poor performance, Buffett transformed the entire dynamic. A losing year was not a surprise or a breach of trust. It was an anticipated, though undesirable, part of the process he had clearly articulated from the beginning. This preemptive honesty diffused the potential for panic and anger. When a down year inevitably occurred, his partners weren't calling him to complain. They were remembering the ground rules they had agreed to. They knew that losses were part of the game and that their partner, Warren, was now working for free to climb them out of the hole. This is a masterclass in managing expectations. He wasn't selling a dream of effortless riches. He was recruiting partners for a long, difficult, but ultimately rewarding expedition, and he was honest about the storms they would face along the way. The underlying psychological principle at work here is the management of expectations and the power of inoculation theory. Expectations are the silent drivers of satisfaction or disappointment. If you expect a smooth, linear path to wealth, any downturn will feel like a failure and trigger a negative emotional response. If, however, you expect volatility and occasional losses, the same downturn is simply a validation of your realistic worldview. It meets your expectations, and therefore it is far less likely to cause panic. Buffett, by being brutally honest about risk, was skillfully managing his partners' expectations downward to a realistic level. He was setting the bar for normal to include periods of poor performance. This is a profound psychological maneuver. He was essentially preloading the bad news. This brings us to inoculation theory. In medicine, a vaccine works by exposing the body to a weakened form of a virus, allowing it to build up antibodies so it can fight off the real disease later. In psychology and communication, inoculation theory works the same way. By presenting a person with a weak version of a counterargument, you can inoculate them against being persuaded by a stronger version of that argument later. Buffett was inoculating his partners against the virus of panic. The weak form of the virus was his calm, rational explanation in the ground rules. We will have losing years. The real disease was the experience of actually being down 20% in a terrifying bear market. Because they had already been inoculated, because they had already been exposed to the idea in a safe and rational context, they had built up the psychological antibodies to withstand the real thing. They were less likely to be swayed by the powerful counter-arguments of fear and panic. Sell everything. The world is ending, because their expectations had been properly calibrated from the start. This radical honesty about risk is not pessimism. It is a sophisticated form of psychological preparation, building a foundation of resilience that is essential for any long-term financial success. To apply this final pillar, we must create a risk and resilience manifesto as part of our personal investment constitution. This is where we confront the realities of market risk head-on and pre-commit to our responses. The mental model is to become your own chief risk officer. Step 1. Quantify your personal risk tolerance honestly. Don't use vague terms like moderate or aggressive. Be specific. Use a historical market crash as your guide. For example, in the 2008 financial crisis, the S&P 500 fell by more than 50% from its peak. I will look at my current portfolio value, cut it in half, and imagine how I would feel and react to seeing that number on my statement. Could I sleep at night? Would I be forced to sell to cover living expenses? Would I have the courage to buy more? This visceral exercise helps you move from an abstract idea of risk to a concrete emotional and financial simulation. Based on this, you can set a more realistic asset allocation. Step 2. Write a when-then protocol for market downturns. This is a pre-planned set of instructions for your future, panicked self. For example, when the S&P 500 has fallen by 20% from its peak, then I will review my watch list of high-quality companies and begin deploying 10% of my available cash. Or, when the media is filled with headlines of financial crisis, then I will reread my investor's manifesto and my decision diary to remind myself of my long-term philosophy, and I will not sell any of my core holdings. This protocol replaces emotional reaction with disciplined action. You've already done the thinking while you were calm and rational. Now, all you have to do is execute the plan. Step 3. Embrace the anti-guarantee. In your manifesto, explicitly write down your acceptance of risk. I accept that there will be years where my portfolio will have a negative return. I accept that this is a normal and unavoidable part of long-term equity investing. I understand that the price of long-term higher returns is short-term volatility. I will not seek guarantees where none exist. This act of formal acceptance is surprisingly powerful. It is a declaration of financial maturity. It's the moment you stop hoping for a fantasy and start planning for reality. This makes you a more resilient, more realistic, and ultimately a more successful investor. The antithesis path of the 99% is the constant, desperate search for the sure thing. This is the investor who is seduced by promises of high returns with low risk. They are the primary customers for every get-rich-quick scheme, every can't-miss investment, every financial product that promises guaranteed returns. They fall for investments that claim to have solved the market or to offer uncorrelated returns, without understanding the hidden risks. Think of the people who piled into complex financial products before 2008, believing they were buying safe, high-yield assets, only to find out they were holding ticking time bombs of leverage and risk. Think of the investors who put their life savings into Ponzi schemes like Bernie Madoff's, lured by the promise of impossibly consistent positive returns, month after month, year after year. The lack of any down months was not seen as a red flag, but as a sign of genius. The 99% investor despises volatility. They see any downturn as a sign of failure, either their own or their advisors. This aversion to any form of loss makes them incredibly vulnerable because they haven't accepted the reality of risk. They haven't prepared for it. They have no cash on the sidelines to deploy during a crash because they were fully invested, chasing the last bit of upside. They have no when-then protocol, so when the crisis hits, their only plan is to panic. They have no psychological inoculation, so the virus of fear overwhelms them instantly. The search for a financial world without risk is a fantasy, and those who chase that fantasy are always the ones who end up paying the highest price when reality inevitably asserts itself. Buffett's final rule is a declaration of war on this fantasy. It is an embrace of reality, and in that embrace there is not fear, but power. The power to endure, the power to prepare, and the power to prosper from the very volatility that crushes the unprepared. The direct financial connection of this principle is the preservation of capital and the ability to seize opportunity. The financial impact of honestly embracing risk is, paradoxically, a dramatic reduction in the risk of permanent capital loss. Let's trace the financial path. By honestly assessing your risk tolerance up front, you construct a portfolio you can actually stick with. This prevents the single most destructive financial act: selling all of your assets at the bottom of a bear market. That one decision can cripple a financial plan for a decade or more. A portfolio that is down 40% on paper will, for a patient investor, recover and go on to new highs. A portfolio that is sold at a 40% loss is a permanent, real, and catastrophic destruction of wealth. The Risk and Resilience Manifesto is the behavioral insurance policy that protects your balance sheet from this fatal error. Secondly, a realistic understanding of risk leads to prudent financial planning, like maintaining an adequate cash reserve. The investor who believes returns are guaranteed will stay fully invested at all times. The investor who knows a downturn is inevitable will keep some dry powder. When the market does crash, that cash becomes an incredibly valuable asset. It is the tool that allows you to take advantage of fire sale prices. The returns generated by deploying cash at the point of maximum pessimism are often the highest returns you will ever earn in your investing life. This action can literally shave years off your journey to financial freedom. The financial statement of an investor who embraces risk will show a smoother long-term equity curve, not because they avoided downturns, but because they didn't panic during them, and they used them as opportunities to plant the seeds of future wealth. This final rule is the capstone of the entire structure. It ensures the longevity of your investment program by forcing you to build it on the bedrock of reality, not the shifting sands of optimistic fantasy. It is the final promise that Buffett made to his partners. The journey will be hard, the risks will be real, but our preparation and our discipline will be our ultimate advantage. So there you have it, the 5 foundational pillars that a 26-year-old Warren Buffett used to launch his empire. A declaration of absolute authority to ensure rational decision-making. A custom-built scorecard to focus on the long-term journey. An unbreakable alignment of interests through skin in the game. A shared philosophy to build a resilient community of educated investors. And a radical honesty about risk to prepare for the inevitable storms. These were not just rules for investing, they were a blueprint for a new way of thinking. A system designed to conquer not the market, but the self. You have just spent this time absorbing a framework that has created more wealth than perhaps any other in modern history. You now possess the architectural plans for a personal investment constitution, a system of governance for your financial life that can protect you from emotional error and unlock the profound power of long-term compounding. This is not a small thing. You have acquired a mental tool of immense value, a shield against the chaos of the crowd and the whispers of your own worst instincts. But a constitution, no matter how brilliantly designed, is only a framework. It is the structure of government, but it does not contain the laws themselves. You have built the courthouse, but you have not yet studied the law books. Buffett's system is a network of interconnected mental models. What you have just mastered is the foundational governance, the operating system that allows the entire machine to run without catastrophic failure. But what about the applications? What about the specific, actionable rules of capital allocation that he used within this framework? How did he identify the undervalued businesses? What were the specific financial metrics he looked for? How did he determine a margin of safety? Knowing you need a rule against panic selling is one thing. Knowing with unshakable conviction why the asset you own is worth holding through the panic is something else entirely. That conviction comes from a deeper level of analysis. The video that is now on your screen is the next piece of that map. It is the link that connects the how of your governance to the what of your decisions. Think of what you've just built as the perfect, unbreakable ship. You've laid the keel, you've raised the masts, you've sealed the hull. You are prepared to weather any storm. The next step is to learn how to navigate. The next step is to understand the charts, the stars, the currents, the specific techniques that take you from having a safe ship to having one that can reach the most profitable destinations in the world. The choice to click is not about watching another video. It is a decision about your own identity. Are you content to simply be a person with a set of rules? Or are you ready to become a true capital allocator, a strategist who not only has a strong constitution, but also possesses the legal and analytical acumen to write genius-level laws within it? The journey to complete your mental arsenal continues. Complete the next stage of your ascent. Click the video on the screen.